the robust investment strategy that I want to talk about today is the third of those sort of three bullet points that allegedly give some sort of credential for being up here, is my role as the investment manager of the Plain English Finance Global Multi-Asset Fund. But so I want to contextualise a little bit how we got to having an investment fund, and the fact that that is very much a retail-facing endeavour. So if you'll indulge me for a few slides, some of these slides will, to this gathering, be very, very sort of Mickey Mouse and simple, but I think they are important to contextualise how we came to the investment strategy that we've produced that Michael alluded to a moment ago. So the founding principle of everything we do, everything I do, and the reason I wrote this book, is that it's all about financial literacy. And I'd hope I'd get a few nods of agreement from the audience that, you know, one of the biggest problems in British society, and I think in the developed world, is that we live in a capitalist society where people really don't understand capitalism. And financial literacy is we all know, we're dimly aware that financial literacy is poor, but the problem is seriously worse than I think even contemporary zeitgeist acknowledges. And I've always thought there's a chap called Mark Shipman, who some suggest is arguably the first true hedge fund manager in Britain, who retired in the sort of mid-80s. So I actually met at a U2 concert quite by chance. But I really like this quote from one of his books, because it's so self-evidently true that there is an essential life skill that has never been and still isn't taught to the masses. It's slightly clunky, but it's a good message. How to manage, control, and invest money to protect and provide for your financial future. Does that statement resonate with people in this audience? It's true. And so my broad message to the market, whenever I do these speaking events with a more mainstream retail-esque audience, I talk about bad news and good news. And so again, with apologies, we'll whip through these slides quickly, but they do set the tone as to why we launched this product. You know, people in this room probably know what the average British salary is. Can anybody shout out if they have a basic idea? Yeah, it's 26, 27, anywhere between 25 and 30,000 pounds a year. So I'd ask a retail, you know, a sort of man in the street audience, well, what do you need to have saved to generate that much income at retirement, assuming you want to retain your capital and not go into drawdown, which is a separate thing. But what do we therefore need at current annuity rates, roughly? Most people in this room will know it's anywhere between sort of £500,000–600,000, depending on whether you're inflation protecting your annuity or not. How much money does the person, perhaps people in this room don't know the answer to that question, how much money does the average person in Britain actually have at retirement today? Anyone want to venture a guess? So from the
tens of thousands.
Yeah, so it's actually, you know, it's about £50,000 for the average man and £20,000 for the average woman. So there's obviously this enormous chasm, and this is part of what informs everything that I do, and you know why I've written a book and we've launched a fund. And then the more general point along those lines is why should we care? I mean, obviously the man in the street should care because they don't want to suffer and be impoverished. But I see this as nothing less than a silver bullet for the individual, because for every individual who invests and then ends up solving that, bridging that chasm, that's obviously great for the individual, great for their dependents. But it's bigger than that, because it's actually really, really important as a silver bullet for nothing less than British society, or transferred to Europe or America or even the developing world. People understanding finance and being effectively financially literate has enormous positive dividends for society as a whole. So this is very much a sort of statement of intent in terms of a mission statement of over and above just a sort of commercial endeavour. So sometimes the rebuttal to that is, well, that's fine, but the government will just pay for me. You know, we have pensions and there's a great welfare state. Well, I think, again, sorry if I'm preaching to the choir here and this is familiar territory, but this is completely wrong. The state pension was introduced in a very enlightened way. I think the Germans beat us to it by a couple of decades. But in 1909, we introduced one of the first pensions in the world. Maybe the Scandinavians were there early too. For the over 70s, does anybody know what life expectancy was in the UK in 1909? 47. Now, obviously, that's skewed by infant mortality, but even the median, there weren't really very many people claiming a pension. There are an awful lot of people working down the mines or building ships or whatever else wonderful post-Victorian thing we were doing to fund very, very few people taking a pension. Now, we all know that that is night and day, 180 degrees different today. And again, apologies if this is familiar territory, but scientists, by day I work in biotech and healthcare, scientists are telling us that a child born today will comfortably live but past the age of 100. Now, if we want a 60-year-old model of retiring at 55 or 60 or 65 or even 70, that's still 3+ decades that need funding. And I refer you to my earlier comments about just how... So this problem is going to get even bigger. So that's the bad news. There is actually some good news. Now, sadly, these slides didn't quite work the way I wanted them, which is I wanted the right-hand side to be a big reveal after posing the question, but we had a few IT foibles. But basically, I asked this question of a more everyman audience, which is a wealthy relative. Aunt Agatha can invest £5,000 the day your child is born. If you can achieve 10% per annum, there could be hisses and whistles and a certain amount of cynicism about a number, but we'll come on to that in a moment. Just to keep the maths easier, again, for the layperson, with no additional investment than a £5,000 lump sum the day your child is born, how much will that be at retirement age of 55? Just £10 compounded. Now, again, many of you will know this. It's a massive, massive surprise to the man in the street that the number's that big, and just for what it's worth, £945,000 is £5,000 compounded annually at 10%. 1.2 million is what hedge funds like Millennium try to achieve. The best hedge funds in the world, which don't try to shoot the lights out, but try to do 1% or thereabouts per month. If you do 0.83% a month, you get to 1.2 million. Now, this is I can see that how do you achieve 10% per annum consistently? This is not something that's necessarily easy to do, but it's really a thought experiment to show people that the chasm can be bridged. It is possible if you invest and if you know what you're doing over time to get to numbers that will give you a comfortable retirement. And more specifically, how can you achieve 10%? Well, the first point I'd like to make, and I always make, is that something that the general population have missed is that today's financial services products are factually the best they've ever been, particularly as somebody who lives in the UK. We have a vastly better retail financial service provision than most of mainland Europe, and to a certain extent, even the States. Normal people can invest up to £20,000 a year, times 2 if you're married. Obviously, you can shift that between spouses, that's £40,000. You can, on top of that, make capital gains. Then there's your SIP. For the brave 15% who are willing to do the work, I think spread betting is actually, I've got to be very careful about advocating for spread betting, but I do think for the financially enlightened people who are willing to do the work, spread betting is just another very powerful tax-free way of investing. And you can do this, I actually, I probably shouldn't own up to this, but I was on holiday in Italy last week, which is where we ran our monthly signals, and I traded the fund from a 15th century Italian palazzo. The man in the street, I can do that as a professional fund manager, and nobody who invests in our fund should be concerned about that at all. Every bit as effective doing that on a laptop as I would be in my screens upstairs. But all of this can now be done online from a tablet or smartphone. That is remarkable, and it's actually vastly more important for people's potential to succeed financially than a lot of the other things people worry about post the financial crisis of a decade or so ago. But more importantly, I think this is an even more compelling slide, is that the world actually continues to grow and become significantly wealthier, and the quantum of that is very, very, very poorly understood, again, by investors who are scared into buying a rubbish cash ISA which guarantees the loss of their wealth every year. And so to put some numbers on that specifically, 32 trillion in the year 2000 was the CIA World Factbook estimates the size of the aggregate global economy, global GDP. That number was up to 85 trillion in 2015. Mathematically, that's 164-ish% divided by 15 years. Now, it's slightly disingenuous, but again, that is a double-digit return. And I'm always talking about high single digits, low double-digit returns being eminently achievable for anyone, but consistently through the economic cycle. And so there's sort of exhibit B as to why this, I'm not saying 10%, I'm saying high single digit, low double digit through the cycle, regardless of what financial markets do. And that's just to evidence that broadly that's in line with just how much growth there is in the world economy. 200,000 new souls being added a day, 75 million people a year. And, soon there will be McDonald's and Henny's and Moritz and Zara in Mogadishu. These themes are running all over the world, and that's why there's been that's one of the reasons, there are lots of other reasons, but why the equities have been so successful in the last 20 years, and I think a lot of people have missed that. So specifically though, let's come on to there you go, that's me done in terms of how I speak to retail investors. Now let's come on to, so how does that inform our approach to actually having an investment fund and investing? So what do we mean by own the world? Why is my book called How to Own the World? It's quite simple, that you are diversified by asset. So shares, bonds, commodities, precious metals, property and cash, not just shares or just property or just cash, which is what so many people, certainly in the retail investment community, do. And by geography, so today that's basically the 3 time zones of the US, Europe and Asia. And that actually is something that has been done by the Rothschild family since 1800, by every and any enlightened family office in the world. People in this room are probably familiar with the quite well-known JP Morgan piece of research, which was published about 10 years ago, that said that the first generation multi-millionaire has a 90% chance that money is gone by the third generation. You know, clogs to clogs, rags to riches in 3 generations. That's the principal worry for anybody who's significantly wealthy in the world, which is why there's been this enormous proliferation in family offices. Even the UK family office industry now is worth about £1 trillion, as I'm sure many people in this room know. And so who else? So family offices, the Rothschild family. And the Rothschild family could do this in the 1850s because they owned investment banks all over the world before, you know, lots of other people could. But slightly later to the party, Harvard and Yale, as many people in this room will know, have very, very successful, consistently performing global multi-asset endowment funds. Their returns are juiced somewhat by alternatives, timber, private equity, etc., but it's still the same fundamental worldview, I would contend. And as do Cambridge and Oxford. So my contention here is who are these people? They're the smartest people in the world. This is how they invest. They invest in a global multi-asset fashion. And Jack Meyer, again, many of you will know, was at the helm of the Harvard University Endowment Fund and returned, I think it was 15.9% annualized for his tenure at the helm, which is a 910% compound return over that period. So he says the most powerful tool an investor has, whether for him or her, is diversification. So I believed in this enough to write a book about it. And if you like, the secret sauce in my book for the man in the street was very simply that the Rothschilds could do this in 1850. Harvard and Yale have been doing it since the 40s. Oxford and Cambridge have probably been doing it since 1850 as well. You can now do this as a normal person with an ISA account with only £25 a month to invest. That has only been the case for the last decade or so. So I've set out this kind of broad worldview, you know, informed by what I deem to be a lot of very compelling evidence, and then the final piece of the jigsaw puzzle, if you like, is that, and you, Mr. and Mrs. Man Street, can now do this. You can enjoy the same consistency of high returns or meaningful returns and the same downside protection that all these lucky billionaires and multimillionaires have enjoyed for so long. So that's the owning the world bit of what we do. What we were missing, and what was if you like, the second fundamental investment approach that underpins our fund and everything we do now, is trend following. And trend following is really important because drawdown is really key, and I think something that is, again, to Michael's point in his introduction about, you know, can you peg the downside and still capture upside? The kind of ephemera that we're all looking for, the perfect investment strategy. Well, we think, and I'll come on to who I mean by we, it's the third bullet point, that you can by using basic backward-looking trend following. And I'll give some evidence about that. And this is particularly important because, why is drawdown so important? Because of the break-even fallacy. One of the tragedies is so if you look at Elroy Dimson and Paul Marsh at the London Business School, many of you will know, have written some brilliant research over the years on the performance, the annualised performance of UK small caps. And they take the Numis 1000, or the bottom 2% of stocks in the London market. And they've shown, does anyone want to venture a guess, those of you who don't know, what the annualised return of UK small caps is going back to 1955? 15.4%. Annualised. But the problem is it doesn't come steadily. It's plus 35, plus 45, plus 19. You know, Harry Nimmo at Standard Life or Gervais Williams at Mine, all these brilliant fund managers churn out these returns, and then they have a minus 60. So 4 or 5 times since 1955, the drawdown has been 50, 60, 70%. And therein lies the difference between the 15.4% annualised figure and what the man in the street actually makes, because they get scared out in a year like 2000, 2000 or 07, 08, and they sell out and they go, shares are no longer for me, I'm never investing in them again. And that is why protecting the downside, and the break-even fallacy, to elaborate, everybody will know, is that, you know, if you start with 100,000 and end up with 50,000 in a year like 07, 08, you need 100% to get back to square one, not 50%. And most people, when I ask that question of most retail-oriented audiences, they don't know that. They think it's 50%. And if you lose 25, you need 33. And if, like Bitcoin last year, you're down 75%, you need 370% to get back to square one. So smoothing returns by using trend following and by using diversification is key to meaning that your annualized return numbers are actually the annualized return numbers that your investors achieve, because they're never scared out of their position and give up on investment altogether by a minus 30, 40 or 50% drawdown. So really by luck rather than judgment, because I think it came when we met, and then the professors were also aware of my book. I met Roderick Collins, who's our panellist today, and the board director of Plaintiffs Finance and the co-manager of the fund that I'm about to talk about. And his rather eminent colleagues, professors Steve Thomas and Andrew Clare at Cass, and we launched the VTPF Global, the catchily named Value Track Plain English Finance Global Multi-Asset Fund, because the FCA wouldn't let me call it the Own the World Fund, because they felt that would mislead investors. They think that somebody at the FCA, is there anybody from the FCA in here today? Anyways, thank goodness for that. But somebody at the FCA actually said to me, we're concerned, Mr. Craig, that investors will believe they own all assets in the world. And I had to call it the rather less marketable VTPF. But just to digress briefly, so Roderick's obviously going to speak today, but to give you an idea of how fortunate I've been, these two professors, quick bio, Steve and Andrew are involved with setting the CFA syllabus, and they have been ranked in the top 10 in the world as the most prolific finance academics in the world. And a particular specialism that Roderick and they both have is trend following. So they have provided me with this rather, I think, really compelling evidence, which is in our the fund overview document that markets our fund. And so I think that's MSCI World from 1971 to 2018, and the one below, actually the chart I really want to dwell on is the S&P chart going back to Jan 1872 to September 18. And the only reason, if you update these, it's the thesis still stands. I just haven't, forgive me, because it's a pretty big undertaking, so we're still using to Sep 18. We will update them soon. But so if you just buy and hold the S&P, go back to 1872, you've got a 9% annualized return, 14% volatility, Sharpe ratio 0.36, and a max drawdown crucially of 82%. So again, it goes back to my point earlier vis-a-vis UK small caps. Layering on, and this, what is this trend following? To elaborate, it's a very, very simple backward-looking moving average. If the S&P is above a 270-day backward-looking MA, not EMA, you're in the S&P 500. If it's not, you're in cash. Let's have a look at how much that improves performance. It lifts annualized return from 9 to 11%. This is going back to 1872. It reduces volatility from 14% to 9.9%. Those of you who know about ratios like the Sharpe ratio and the Sortino ratio will therefore understand why that improves those ratios. And so the Sharpe goes from 0.36 to 0.7, and the maximum drawdown, and this is 100% US equities index here, the maximum drawdown goes from 82% to 47%. That is remarkable. I think that's one of the most compelling charts I've ever seen in 20 years of a city career. It works in the MSCI World, and actually in our marketing document, I've also, well, the professors have kindly provided us with evidence in basically for commodities and for property, and this basically works in any asset class. Now, it works very slowly. You're never going to sell at the top, you're never going to buy at the bottom, but you're going to haircut and protect the downside. So, and just specifically again, to evidence that a bit more, the blue is our actual fund. It's the strategy back-tested and simulated to Jan 2001. The green is the actual performance since launch, although it looks rather better now because we're up 8% year to date this year, and that's only to Sep 18, and obviously everybody knows how 18 was last year, which I'll come on to in a minute. But crucially, the red is the FTSE. It's actually the MSCI UK, which is basically the FTSE and a few bits and pieces. And the orange is what many pension funds might give you as a sort of blended lifestyle, 70% MSCI UK and 30% gilts. So let's, 02, 03, 04, FTSE's minus 37, blended's minus 30, we're minus 7. Same again. And it goes back to my point I made earlier about just how important downside protection is. So it achieves the downside protection. Then the question is, and actually just the evidence specifically how we achieve that, we have 24 assets that own the world, so that's the diversification. And anyone in this room could articulate to me you could probably guess what 20 of them are. FTSE, S&P, Nikkei, gold, energy commodities, bonds, dollar, sterling, and so on and so forth. And we're entirely transparent as to what those 24 assets are to implement our strategy. And this is a pictorial representation of what those 24 have done. There's equity, bonds, commodities, you can see the colour coding. Crucially, look at green, which is cash. Or because of the UCITS rules, a risk-free cash equivalent, so short LICs or Euribor, short bond funds that are an equivalent notional risk-free asset. You can see that, so all we do is, once a month, we look at these 24 assets and we say, are we in whichever silo it is, the S&P or the FTSE or gold or energy commodities, or are we in cash or a cash equivalent risk-free asset? And again, we don't get out the top, we don't get in the bottom, but as you can see, as 2008, as the GFC rolled on, as the Australians like to call it, the global financial crisis, we ended up being over 90% in cash or cash equivalents, And then as the market recovered, we were back to our maximum allocation of 45% in equities, purely based on these very, very simple, elegant, backward-looking momentum indicators. This is not quant stuff, this is not black box stuff, this is really simple. Like, I'll flatter us to say, like all great ideas, it's a really simple idea. And so, just to sort of sum up, if you like, the two key investment themes that inform what we do are true diversification. And when I talk about true diversification, what I mean, as I said earlier, is by asset and by geography, not, as so many IFAs in this country do, by owning 4 different UK income funds or UK alpha super duper brilliant fund picker funds, which mean that actually you have enormous concentration risk and you own a hell of a lot of BP, Shell, HSBC and so on and so forth. This is true diversification across all assets in all geographies, and with the trend following overlay, as I say, applied once a month to a fixed set of assets. So the professors started empirically with 97 assets, which is basically, how do we own all assets in all geographies, which is our fundamental worldview. There are 97 decently liquid things that you can implement that idea with, and we chopped and chopped, or they chopped and chopped, because they're vastly better at such things than I am, but chopped and chopped to get to the sort of, if you like, the Goldilocks number, where you get the benefits of the diversification, but without all the cost and complexity and administrative pain of owning 97, and that is 24. And so one of the ongoing jobs that Roderick and I have running the fund is just to proactively steward those 24 assets, so that if the Vanguard S&P is the cheapest with the best tracking error, we switch out of the other S&P 500 into the Vanguard. That's obviously very, very obvious in things like the S&P 500. It's less obvious in sort of Eastern European, MSCI EM or whatever else you might use. So by doing that proactively, we can actually pick up meaningful basis points to performance and improve downside protection and so on and so forth. So how do I justify to the FCA that I'm a fund manager? That's one of the ways we do it, given it's such a formulaic approach to investment. So the final section, you'll be relieved to hear me say, does this actually work? Well, it's the tortoise of investment products. The key thing, as I said, is downside protection. That is back-tested performance 01 through 17. The most important thing to pull out from this, particularly for somebody who's 60, let's say, or for an endowment fund or a charitable fund or any of those sorts of market participants, is the negative years, 02 minus 1.4, 08, the worst ever down year we've had, minus 6.3, 11 minus 2.8, I've pulled them out in orange. But in the positive years, when the trends are running, look at the quantum of the upside, 19.6, 23.7, 21.5, 22.4. Is it a panacea investment product? I think it, there's no such thing, but I think it's certainly getting there because it does have robust downside protection. It does capture significant upside when markets are trending discernibly. And the only downside is that, like all tortoises, is sometimes it doesn't move very much, and it snuffles along and focuses on a lettuce. But if you're 58 or 59 or 60 years old or running a charity or an endowment, to be honest, that's what you want, rather than a 40% downside year. And I hope that statement makes sense and resonates with everyone. And then this is obviously more for sort of the retail investment community, but that was just to show, if you start with £100,000, which is sort of, dare I say, a young professional or upper middle class person's savings pot at 35 or 40, and you're able to max your ISA for the up to retirement, you start at 100,000, you get to £978,000. Those are the real numbers, just to invest, maxing your ISA every month in the strategy. And that obviously makes quite compelling reading for people who are scared of investing in anything other than a cash ISA or property. I should just add, these have been simulated numbers other than the green. Last year the all share was down just shy of 13% and the FTSE 100 was down 12.47 I think, as most people in the room will know. We were minus 6.3, so I think it sort of did what it said on the tin last year in its first year in anger. It protected the downside. This year we're up 8% year to date. And actually, again, to go back to that volatility point, somebody in the market who was down, CAC, DAX, Shanghai, a lot of the markets last year were down 18, 25%. Bitcoin was down 75%, which sadly so many millennials have been hoovered into with the great promise of riches. But again, as most of you will understand, but very few people in the retail market understand, if you go from 100 to 80, even though 8% this year to date, lags equity markets that have bounced, particularly the S&P, if you'd had £100,000 in our strategy last year and through to this year, you'd now, in absolute terms, have more owned our fund than you would having owned the more volatile equity markets. And you've been able to sleep better at night, I would contend. So the one final bit I wanted to do, again, really was just to show that, to go back to evidencing how important trend following is. The blue here is the 24 assets with no trend following overlay on it, as against the cyan or the light blue, which is the same makeup of with the diversification, but with the trend following. And again, it goes back to my point earlier. The man in the street is their fund goes. They log on to Hargreaves Lansdown or Interactive Investor, and they see their £10,000 is now £7,000. And quite a few give up on investment, but if they see that it's £9,000, there is a little margin in there, which means they're more likely over time to achieve those annualised numbers and not be scared out of their position, which they'll certainly be scared out of by, again, FTSE and blended with the same components I showed you earlier. And just the final sort of, if you like, working backwards to why this works intuitively, and many of you will be familiar with Harry Brown's work, the permanent portfolio. And if not, get a copy of my book and I elaborate all everything Harry Brown achieved. But Harry Brown was working in the early 80s, sort of bow tie wearing dentist from Delaware, serving kind of American financial advisor. And the permanent portfolio was like the precursor to this in an era where there wasn't the same phenomenal range of ETFs that you can implement this sort of strategy with. And so he basically owned 25% gold, 25% US 10-year, 25% cash, and 25% Dow Jones 30. Because that's what you could own back then when everything was paper, there was no online trading. And it basically has the same performance metrics, roughly 7, 8, 9, 10% per annum, but without quite the downside protection you have by having a wider set of investments and the trend following overlays to really cut out those big down years. But so this is Harry Brown's work, is the reason I mention him, is that those 4 asset classes and the asset classes that we own will benefit from the 4 distinct economic phases that any student of economics is familiar with. Prosperity, where shares and bonds go very well. Inflation, where commodities, particularly precious metals, go very well. Recession, where you want to be in cash and have perhaps some defensive shares. And deflation, where you want to be in cash and bonds. And his insight was that overboard, you'd think that would make a sort of anodyne porridge portfolio, but actually over broad periods of time, the winning investments add more value to the portfolio than the losing investments take away. And that is even more the case if you layer trend following on the top. So my final slide is, so in conclusion, owning the world, I mean, I've put disruptive idea question mark. It's not really a disruptive idea, it's an idea that's been employed by the smartest and best investors for the last 200 years. But I think it's disruptive in terms of it's not very mainstream. Very few IFAs will put their clients into precious metals, for example. That's just one example of why I feel that our particular flavour of what we do is somewhat disruptive. And again, that last bullet is aimed at explicitly at IFAs or wealth managers who are trying to service their clients. Because our pitch to them, if you like, now as we build a longer track record and have more assets under management and can therefore be given consideration by those sorts of investors, is that if you park if you have the 100 minus your age rule about asset allocation, so somebody who's 50 should basically have 50% in equities/risk assets and 50% in cash, bonds, less risk assets. Once you've run that schema, you can consider our fund the risk-off bit, and yet achieve returns that are significantly better than gilts or whatever else you might put in that bit. And then that leaves you more time, and you can get on with worrying about what I've, apologies for the language, but described as the sex and violence bit of the portfolio. So high alpha stuff, small caps, biotech, alternatives, PE, whatever else you might want to put in there to juice your client's return, given their attitude to risk. And I think that's me done. So I should have said at the beginning, please stop me if you've got any Q&A. I forgot to say that, but now I'll hand over to Professor Mainelli.